Yeah, so I guess to start, let's give a little overview of what a zero DTE actually is, right? So a zero DTE is a common name for options that are held for only one trading day, and or they exist for only one trading day. And so usually you're gonna do this at the beginning of the trading day, or really you can do it any point in the trading day except for 30 minutes before the close. Uh, and these can be options that are at the end of their expiration cycle, or these are options that are issued for one day. And in the last few years, zero DTE options have exploded in popularity. I don't remember the statistic or something, but I think like since 2019, it's increased by like 50% or something crazy like that.
I mean, I wouldn't be surprised if it was even more than that. I mean, we've seen like a huge boom, especially driven by the retail traders, which I love. We've seen a
It's
huge
usually
boom in
retail, I'm pretty
retail
sure.
activity in the zero DT options.
Yeah, exactly. And so then just kind of begs the question you could say is why would you trade a zero DTE option, right? So zero DTE strategies are typically popular because they offer investors and traders the ability to potentially make gains in a very short amount of time. And you're usually scalping value off of the markets as these expirations come to the end of their life cycle, basically. So that's the what and the why, which is, the fun, not the not so fun part is just slinging trades. But yeah.
Yeah. And so just so we're all on the same page here, a little bit of more housekeeping as well, which I should have covered in the beginning. Right now, we're on the web platform, very similar to the desktop platform. All the functionality is pretty much the same, but you can access this platform on my.tastytrade.com. That's my.tastytrade.com. Feel free to log in there. You can also follow along through the desktop app as well. Either you'll be able to place zero DT trades on. And then just to go over what symbol we'll be using for the majority of the time, we're mostly going to be using SPX, as you can see here in the top left. Let me draw a little box around that. And so SPX, this will be what we see as mostly traded for zero DT options. We'll go over some of the other products you could trade as well, like SPY, XSP, or also the ES as well. We'll go over that towards the end. All trades today are going to be in SPX. That's typically what we see people trading. And then just to pull up the live symbol, what you would do is at the top where it says find a symbol, you just search in here, SPX, hit enter, and then that'll pull up for you there. And so Luke, we talked about, what zero DT options are and why people trade them. What are some of the risks that come with zero DT options as well?
Yeah, so zero DTEs, we'd like to reiterate, there are risky strategies, and there's a lot of reasons why. So for one, if you're a smaller account trader, a zero DTE option can put you at risk of getting a day trade. And one or two day trades on an account are not the end of the world, but if your account's below 25,000, in basically what's called net equity, which is just the sum of all your positions in cash, if you get more than three of those day trades in a 5 business day period, this can shut down your account. And you only get one pattern day trader reset. So if you put on a zero DT option and let's say it goes in the money and you have a smaller account and your account can't handle what we would call the expiration risk, you could potentially get closed out by the risk team or have to close the trade, giving you a day trade. So that's one way that it's risky is just the general, you could get labeled as a pattern day trader. But really the biggest risk is the expiration risk. And so they have significant expiration risk, which is the risk of getting exercised or assigned, where exercise is where you're long an option and you basically take the shares or give the shares away, or you're assigned, which is where you're short the option and you're forced to give or take the shares. Um, because options are derivatives, right? They represent what's called a notional value, which is a much larger value than typically what the option is priced at. And so taking an exercise or assignment overnight and not intending to can have a lot of negative consequences for your account if there's a pre or post market move that, could end up putting your account at a significant loss. Um, and also, again, it puts you at risk of potentially being closed out by our risk team, which no one ever likes being closed out without placing their own trades. So just keep this in mind. If you have a smaller account and you want to try some zero DTEs, make sure you don't overload it so that you don't find yourself in a pattern day trader call or with a lot of expiration risk that you can't deal with. So that's a not so fun part of this. So definitely something we have to let you know before we get into the fun stuff.
Yeah. And so in terms of like what account size applies to the pattern day trader rule, if you're classified as PDT and you're below 25,000 in total account value, minus any futures or crypto positions, that's when you have to worry about PDT. Otherwise, if you're above 25,000, you're good to go. But that's one of the things that we love about SPX is that it's a cash settled index. So let's say some of your position that's a spread expires in the money, some of it expires out of the money. It all settles to cash, and there's no outright stock or outright futures positions that you have to carry, like some of the other products, which we'll touch on later. But SPX is typically what we see people trade for 0DT. It's the biggest product out there, and for its size, it's by far the most liquid. It sees the most activity. And so that's something that we really like about SPX. And then let's just go into some of the platform setup here. I want to go to the positions tab first. And then here, I just want to go over some of the columns that I like to see the most for 0DTE traders. And this can be changed in the settings here. And so feel free to take a screenshot of this. I'm just going to go over briefly what I like to see when traders are using 0DT options for their strategies. But so it'll just be trade price. That's what you get in the trade for. Your mark, that's what the price of the option is currently trading for. And then we've also got cost. That's the actual dollar value that your entire position is worth. So let's say you did 5 contracts for $1. Your trade price would be $1, but your cost would actually be 500. So it does the math for you. And then net liquidity is just the mark times contracts times dollars. So it just shows you where your profit and loss is coming from. And then I also like P&L day. I like with the percent bar just for a bit of extra visual, and then P&L open with percent bar. And then we've got the P&L open with percent bar change, or excuse me, got the P&L open change percentage. So that's how much your position has moved on a percentage basis. And then we've also got, of course, your net delta and net theta. So the Greeks that you're looking at when trading 0DT options. So feel free to take a screenshot of this and then add this to your positions tab later. And then let's go to the trade page on the left-hand side. And then from here, this will show you all of your different expirations. And then make sure you're looking at all the expirations, not just some of the monthly expirations if you want to trade 0DT options. And remember, for all of our trades, we'll be looking at SPX. And then to get and actually start placing some trades, you click on the 0DT expiration, and then this will pull up the option chain for that expiration. And then here, I just want to point out the expected move. A lot of the time, when you hear people trading 0DT options, they're talking about the expected move. So we got that in two different places on the trading tab here. And so we've got it on the actual option chain, which I absolutely love. This brown bar that I just put in the box, that will show you the expected move on the actual options chain and go over the different strikes that are there. So right now it's between like 66.42 on the downside, and then let's call it 66.65 on the upside, and that'll show your expected move. And then we've also got it in the top right as well as an actual number value. So it looks like it's $11.14. And then every platform has this, but something that we do that I love is having that brown bar on the actual option chain.
It's one of the best
And
features
then,
that we have on the platform without a
yeah,
doubt.
right. I love that.
Yeah. And
And
I'm sure
then
you're about to go over this with the
just to talk about how the actual expected move is derived, it comes from the Black-Scholes model. But what we're doing is we're taking 60% of the at the money straddle, taking 20% of the next out strangle, and then 10% of the third furthest out strangle. And then when you add all those numbers up, that's what gives you the actual expected move. But so you don't have to do that math. I mean, you could always just look at the straddle for a different type of calculation as well. But typically, we just look at what's on the platform for trading. That'll give you the expected move. And then just to go over some of the other lines that are on here on the option chain, we've got the one standard deviation. Let me draw an arrow to that. You've got the one standard deviation line, and that'll show on both the put and the call side, the upside and the downside. Got the one standard deviation if you want to base your trades around that. And then we've also got two standard deviation lines as well. So if you want to base your trades around any of these different numbers, then you can look at the lines that we have on the platform. We make it super easy for you to see to be able to place these well-informed trades. And then,
yes,
okay.
those
From
standard deviation
here,
lines are
we're
very
going to start
useful.
getting into placing some trades. Yeah, now here's where we're going to have some fun. And so everyone should get ready, buckle up, put on your trader caps, and we're going to go. We've got how many strategies do I want to go through? One, two, three, four, five, six, seven. So there's seven different strategies that I want to go through here, and I think that's about all of them. And so we're going to be pretty quick when it comes to going over these strategies. Most of them are just derivatives of one another of the strategies. So like when you do a put spread, if you just add a call spread to it, that's an iron condor. And so, everyone, let's get ready. I think, Luke, let's start out with something simple like a put credit spread on the zero DT options. Does that sound good?
Sounds great to me.
Okay. And so it's super easy to place a trade on the Tasty Trade platform. Let's say we want to sell an expected move put credit spread. And of course, none of these are recommendations. These are all just example trades. We have no clue what's going on in the market, especially for this given day. So none of this is recommendations. These are all just example trades that we're putting on for you guys. And so here for a put credit spread at the expected move, we could do the short strike at about the 66.40. And to sell that, we'll just click on the number under the bid column. And then after that, we'll just click on the number under the ask column for the 66.35. And then this right here will pull up a put credit spread for you. And then if you want to change the width of the spread, you can just click on the long leg and then drag it further out. If you want to do something like 20 wide, you can click and drag it there, or you can click and drag it to make sure that it's, just 5 wide, whatever you want to do for whatever size that you're looking for. And then once you click those buttons, that will pull up the order ticket. Do is we can change the quantity or quantity down here. Let me draw a box around some of this stuff and make sure that I'm not going too fast for the first trade, right? So you can change the quantity by using these quantity buttons. If you want to do a 5 lot, for example, you can just use the arrows to go all the way up to 5, or I'll go back down to 1 and then show you in the order details on the bottom left. From here, you can also type in the boxes as well. And so you can just click on this, delete the 1, and then type the 5 and hit enter. And that will also change the order to quantity for you as well. And then from here, once you've got whatever quantity you would like, before Scada gets on my case about,
Hmm.
throwing 5 lots in on the business account, let me just move that down to 1. And then from here, you can change the price. I typically like to use these little price arrows that we have on the right-hand side. Let me draw a box around this as well. You've got these price arrows that you can use, or when using these price arrows, you can put it, it'll automatically start at the mid price, or you can use the price arrows to adjust it from there. And then you can also type in the box, let's say we want to go 90 cents, go to the mid price, and then it will save it from there. Typically, I like to use the price arrows though.
I always like to go to the mid if I can.
Yeah,
Right,
start at the mid. And then
double
so here it looks
clicking the
like, I mean, the
midpoint.
markets are
Yeah.
moving fast. That's what happens with the zero DT options, right? And so here we'll start at 90 cents and then we can see how to work an order as well. And then so once you've got the order pulled up, you can click review and send. And then of course, check over the commissions and fees. And then especially when trading SPX, it can be a bit of a more expensive product to trade just because there's a specific CBOE fee that they charge for SPX. And so once you reviewed your commissions and fees, make sure that the trade looks good. You can hit submit, and then that will place the order for you. And then so it looks like we're not getting filled yet, right at the mid price. And so what we can do is this is my favorite way to work an order on the Tasty Trade platform is take a look at these yellow buttons on the right hand side. What I'll do is, okay, looks like we got filled there. We'll show it for the next one. But my favorite way to work an order is by right-clicking those buttons that are on the right-hand side there. And so this would be a put credit spread, and then this is how it shows on the option chain. And then let's also go over to the positions on the left-hand side just to take a look at our positions and see what it looks like on the trade tab. So we'll click on that here, and then it will drop down both of our option legs that we have, and then show all the different statistics for your given position.
And there you have your headers set up perfectly. Trade price, mark. So you can see what's going on the entire time well. Uh, And I personally love the profit loss open because that's going to tell you if you're making a profit or not immediately. Obviously, these are zero DTE, so the PL day is going to be accurate as well. But
Yeah, I guess right. P&L open, you don't even necessarily need. Usually I just have that as like my regular screen setup, but feel free to add that or not. And then when it comes to closing a trade, it's super simple to close a trade. So first, we'll actually do a 50% take profit, and then we can go and change the trade price and then work the trade. And so what you do is to close a position, you click, this is the left click, by the way, you click on both option legs. And then once you have both of them highlighted, you can right click and then it'll pull up a menu that says close position and close it percent profit. And then on the close it percent profit, you could change this to something like 60%, for example, or you could use the plus and minus arrows as well. Just to keep it simple, we'll put it at 50%. And then from here, you'll hit that blue arrow, and then that will just pull up an order ticket for you. And it will already have the price at the give and take profit that you insert there. So for 50% profit, of our trade price was what, 90 cents. And so it'll automatically pull up that 45 cents for you on the order ticket. And then you could always adjust it from here as well. If you want to say, hey, maybe I'm fine with 5 cents less than that, or maybe I want a little bit more of a profit with the arrows or by typing it in as well. Just to keep it simple, we'll keep it at that $45, 50% profit. And then once you have this order ticket pulled up, you can hit review and send. Of course, check all the commissions and fees. No commissions on closing a trade, but fees still do apply. And then we can hit submit, and then that order will start working. And then let's go over how to work an order on the Tasty Trade platform as well. And so I'm looking at these yellow boxes that are right here. This will pull up on your option chain, and then it looks like just like a little yellow W on the downloadable trading platform. But if you're on the website, it'll look just like this. And then from here, all you need to do is just right click on those yellow icons, and then that'll pull up a menu to say cancel, replace, similar, or opposite. If you just want to cancel the order, you can click cancel. But if you want to replace the order, change the trade price, you can hit replace. And then that will automatically pull up an order ticket for you. You can change the price. Let's just go straight to the mid, and you can click on it as well, the mid price. Let me draw an arrow to that. You can click on that down here where it says mid. Once you just click on that, it'll automatically pull you to the mid price. And then so from here, we'll leave, geez, the mid is jumping everywhere, Luke. I mean, the markets are active right now. I love it, actually. This is
Well,
really
and
exciting.
actually, this is something I like to point out with this zero DTE options trades is a lot of times on SPX, these prices will be changing wildly throughout the day, especially as you get closer to the end of the day. These can move like 20, 30, 50 cents sometimes in seconds. So if you're having trouble getting a fill, you might have to wait a second or just keep replacing the order as close to the midpoint as you can, because it can make it difficult sometimes with how much these are traded towards the end of the day.
Yes, yeah, exactly. So we'll just try at the mid price right here of 95 cents, hit review and send, and then submit. And then just to perfect, we just got filled right there. And then so we're good to go. And then that was the put credit spread. Now we're going to go a little bit faster and then just go over some of the different strategies. So there was your credit spread. And then now next on the list, I've got a debit spread. And so, for example, we can buy an out of the money call spread. And so to buy a spread, you would just click on the bid of the option that you want to sell, and then the ask of the option that you want to buy. And then boom, that automatically pulls up your order ticket right there. And then so you'd want this to expire higher than your short strike to make full profit. And then to be able to place this trade, we'll just go 5 cents above the mid price. Even though the mid's moving all over the place, we'll try 5 cents above the mid price just to get it filled. And you can hit review and send and then submit. And there you go. There's your
There you
trade.
go.
A super quick and easy way to place zero DTE trades on the Tasty Trade platform. And then when you're looking at a position like this, you really want it to expire above that short strike for full profit. If it expires anywhere in between, then you could see potential varied profit or loss, depending on if it's beyond your break even or not. And then if it expires anywhere below that short leg, or excuse me, below that long leg, then you're going to see max loss, which would be whatever you paid for the spread. And then to see what the actual trade cost was, we can go to the positions tab, and then it'll show you right here. Our trade price for the total spread was $1. Right now it's marking at 95 cents. Profit and loss of $5. Super easy, straightforward way to see these positions on the platform.
So yeah, and so the reason these are a lot of these are zero DTE strategies, right? So we just did a debit spread, right? So the idea of doing an SPX debit spread is you think SPX is going to go a certain direction. And in this case, we're thinking SPX is going to go up for the day. So this long one is near the expected move right now. Excuse me. And so the idea is that, oh, I think SPX is going to go up this amount today. And you're basically going to scalp the profit from we paid $1 for it, but we're hoping that it might end up as $1.50 or $2. And likewise with the credit spread that we did earlier, you're basically hoping that this expires out of the money. You're basically saying the opposite. I think SPX is not going to move this far. And then you just take the credit as a profit. As long as you can handle, and since this is cash settled, more than likely you can handle the expiration risk.
Yeah, so your max loss will never be on a debit spread. Your max loss will be never more than what you paid for the spread. And then on a credit spread, it will never be more than the width minus the credit received. So for this example, our max loss would be, what was our trade price? $1. So our max loss would be $100. And then our max profit is the difference between that and the width of the spread, which is $5. And so we could make a potential $400 on this. And then we happen to have a quick profit right now. And so let's close out of this trade. We've got it for, let's put it, yeah, it's right at the mid price at 125. We can hit review and send and then submit the order. And then there you go. That debit spread's closed out. And then what's the next strategy on the list? The Iron Condor. So now the Iron Condor is just a put credit spread and a call credit spread combined. So let's say we wanted to do a one standard deviation Iron Condor. So that would be, we could straddle the one standard deviation line, for example. And then on the call side, we would do the same thing. Click on the bid of the leg that you want to sell and then click on the ask of the leg that you want to buy. And then there is your Iron Condor right there. What's this trading for now? About 80 cents, 85 cents. We'll try 85 cents, see if we get filled. And then here, when placing this type of trade, you want it to be in between the short strikes that you have of 66.35 on the put side and 66.70 on the call side. And then once we've got this order pulled up, we can hit review and send and then submit. And then, all right, we're going to see just live working this order here, tick by tick. We'll go 5 cents at a time. All right, looks like we're not getting filled at 80 cents. They're jiffing us, Luke. They're jiffing us. And then let's try 75 cents. And then there you
Uh,
go. Filled at
okay.
75 cents. And then so Luke, tell me about like why people like the Iron Condor strategy and what you're looking for in order to receive profit.
So yeah, so what I like about our expected move here is that you can see that both of the wings of the condor are outside of this expected move. So given the statistical information we have now, this was the short condor, right? Just so we're talking about the same thing. If this is a short condor, right, you're hoping that the expected move is correct, that you basically get a 1 day trade where whatever value we got from this expires worthless, we get to keep it. If this was a long condor, we might change the wings a little bit, put them closer. So we hope one side goes in the money. We put the condor closer to the expected move. But since this is a short condor, we're putting it very much outside the expected move. But the caveat with these, right, as an option gets closer to expiration, it's going to lose a lot of its extrinsic value. And so these out of the money options have only a little bit of extrinsic value left. And so I think the hard part with these short options on the zero DTE, especially with the condors and the spreads, is finding options that have enough extrinsic value to where you can still make a profit and you're not picking up, as they say, pennies in front of a steamroller. But also simultaneously, especially on the short strategies, you can't put it too close to the expected move because you obviously don't want it to be a losing trade. So Quentin put this up perfectly, right? Where we're about 5 points, 10 points out of the expected move. There's still extrinsic value to get here, but we're hopefully not putting ourselves at risk of any assignment or going in the money of our options.
Yeah. And so something we can look at is like our probability of profit, right? So when we pull up this same order, it shows a probability of profit of around, yeah, 66%, 67%. That's something you would expect at around this move. And then what comes with that, high probability of profit is a lower overall potential profit. Like for example, on this trade, we could only make about 80 cents or we got filled at 75 cents. So we can only make that credit that we received. But then you also have a very high probability of making that credit. And then from there, you can decide what risks you want. Do you want the high probability of making a smaller amount, or do you want the low probability of making a larger amount? And so we can go ahead and close this trade here and then talk about, sort of like not the full opposite, but then we can go into an iron fly as well, which is a much tighter profit and loss window, but you get paid a lot more for taking on that risk. So let's go and close this out. Let's try and just get break even here. All right, there we go. And then an iron fly. What's that? So that will be where you sell the straddle. I guess it's right in between these strikes, but what you'll do is you'll sell the straddle and then you'll buy the wings. So for this, we could do something like right at the expected move or just outside of it. You could try the 66.40 and then the 66.65, or I guess that would be uneven, 66.70. And so this would be a 15-point wide iron fly. And so what you're looking for here is to pin right at those short strikes. And so your probability of profit, let me draw a little box around that down here. Your probability of profit is a lot less because you're getting paid a lot more. Like for example, this 15 wide spread is going for, let's just call it, 875. You're getting paid $8.75 for this entire trade. Of course, your probability of making that money is a lot smaller, but you're getting paid a lot more to take on that risk. And then, so from here, what we can do is if we think it's going to pin right at 66.55, we can place this trade. And then this is, sort of like it's close to a 50-50 shot that you're looking for with the iron fly. And so if you have a thought in your head, you think it's going to pin, the short strikes right there, right at the money, then an iron fly is a strategy that you could consider. And then so from here, we'll try and get filled at 875. We'll probably have to work it from here. But yeah, I see the mids 865. We can just go down to there, see if we
Give the
get
market
filled.
makers what they want.
And then there we go. And so right now we're hoping for it to pin right at 66.65. This is a strategy that you can use, if you have a number in your head that you think the market's gravitating towards, up to you, however you determine that. You can look at the VWAP, you can look at the volume graphs and stuff like that. But depending on, whatever comes from that assumption, you can take a look and say, hey, in this case, I think 66.55 is right where we're going to pin. And then you want to use a premium selling strategy to get there. That's where you can use the iron fly. And then so to close this trade out from the option chain, what you can do is you can click the opposite of the way we put it on. So if you click the bid to open it, you can click on the ask to close it. And then this is how I like to typically close positions if we're not on the positions tab. Of course, you could be on the positions tab for this one and seeing where it is and then just close it from there. But typically, what I like to do is if I'm trading zero DT options, I want to be really quick with my scalps. What I can do is just click on the opposite sides of each order and then boom, your order ticket's pulled up right there. So just to go a little bit slower than that, we clicked on the sell on the bid to open this short call right here, this 66.55. So to close it out, you'd be placing the opposite trade by clicking on the number under the ask. And so what we would do is we would pull it up like that. And then on the web platform, it'll also show a little bit differently. So that's how you know you're doing a closing order as well. And then to go through it for the next one, we bought this leg to open. So we're going to sell it to close by clicking the number under the bid. And then from here on the 66.55 put, we'll click on the ask. And then on the 66.40 put, we'll click on the bid. And then this will also pull up an order ticket for us. Let's see man, these markets are jumping all over the place. Let's try 880, see if this works. Review and send. Alrighty. That's working. We may have to give them 5 cents more. 885, submit, and then there you go. We got
Right.
filled at 885. And so it's super easy to place some of these strategies and then close them out from the option chain as well. And then we'll just go through a few more strategies. But at the end of the day, they're all different versions of spreads that you're doing. So typically, when we see people trade 0 DTE, we don't see a lot of strangles or straddles just because the requirement in SPX is so much higher. You could do something like that in SPY potentially, but typically what we see with SPX 0 DTE is a lot of spread trading. And so it's all just different versions of either selling a credit spread or buying a debit spread. And then how you do that would be completely up to you. And then some of the next strategies we'll look for is a butterfly. And then, so it's pretty much like an iron condor, but it's all on the same side. And then you always want to trade the out of the money options as well. And so that's the difference between a fly and a butterfly, is that it's all on the same side. And so when doing a butterfly, let's say we want to go right to the expected move here. We can buy this, sell this, and buy that. And then we can change the quantity by clicking on the middle of the strike that we're selling, and then it will highlight just that. And then from here, we can go to the order ticket and then click on these quantity buttons. I'm going to draw a box around that.
In a queue this time, why don't you,
Yeah.
before we place this trade, let's show them the analysis graph so we can get a nice visual of what the profit and loss
That
looks
is
like on
a
this
great
butterfly.
point, Luke. That is a great point. Okay. And then, so when changing the quantity, if you want to change the quantity of one leg, you want to make sure that it's highlighted here on the option chain. And then you can just change the quantity. And then you'll see in the order details in the bottom left. And then this will show that we've got a 1-2-1 here. And then this will be your butterfly trade. And then let's go to the analysis tab. And so to analyze this position on the web platform, on the right-hand side, you'll want to click on where it says analysis. Let me draw an arrow to that. We've got the analysis here. And then when I click on this, it will pull up to activate analysis mode. And so from here, we'll want to click this button at the top. We'll want to click on the activate analysis mode. And then once we click that, that will pull up an analysis of the trade page. And then from here, let's use these buttons to zoom in a little bit. Okay. And then so from here, this will show our different profit and loss graph that we have. And then let me pull up the correct zones here. And so this will show your profit and loss. So for example, for a butterfly, this is a really low probability trade, but it gives you a really high payout. So for example, let's say we buy this butterfly for 50 cents. That has a max profit up here of 450. And then your max loss is only the 50 cents that you trade for.
So whenever I first started trading options, I always wondered where they got all these funny names from. And I always thought the graph kind of looks like a butterfly a little bit, upside down. But that's just me. But this is a very nice visualization of the profit and loss in a trade like this. And you can see how if you look at your expected move, glad someone else sees it too. If you look at your expected move, you could hypothetically write this butterfly where this green part is within your expected move. And so that's a beautiful thing about all the visuals we have on the platform is it can really help you see it because a lot of this stuff is very abstract and also seems very how do you say it intimidating. But that's where the statistics, the expected move, and seeing a profit and loss graph like this can really help you get an idea of what needs to happen for your trade to be successful.
Yes, exactly. Yeah. And so this will show you like your different profit and loss zones that you see. You want to make sure here as well on the right-hand side, it just gives you a really good like visual representation of that. And then on the right-hand side under zones, we'll want to make sure you have at expiration clicked because this will show at the end of the day where you want that to land. In this case, we want it to land right under that profit tent of right at that short strike of 66.50. And then if it lands right there, it'll be, a full profit of 450. And then if it lands anywhere in between that tent, could be varied profit that we see there as well. If it lands outside of the tent, then it'll be max loss of whatever you bought the spread for. And then so from here, we can actually also send the order from the analysis page as well, because it is a different type of trade mode. So from here, let's just try and move it to 60 cents, see if we get filled. We can hit review and send, and then submit there. And then looks like that's working. And then also from here, you won't see the yellow W's like you do on the option chain. But what you can do is on the right-hand side, you can click under activity, and then this will show you all of the activity under the account based on the different filters that you have here. And then you can just right click on this and hit replace. And then from here, you can change the trade price. We'll try 70 cents. And then from here, you can hit submit. And then looks like that's still working at 70 cents. We can try 75 just to get the example trade on. Wow, man, Luke, we might have made a good call here. It's like inching right towards it. Maybe we leave this on for the rest of the day.
Hey, we'll
See
see.
see what comes of this.
Maybe they'll add it to our salary if we make a profit. Who knows, you know?
Hey Scott, if you're watching this. And then so from here, we can go back to the option chain, and then it's under this trade mode here on the top left. It would be under this trade mode. And then from here, we can click table, and this will bring us right back to the option chain. And then so this is how the spread looks when you're doing a butterfly. This is how it will look on the option chain. And then just two more strategies that I'd like to go over here as well is the broken wing butterfly. This is a strategy that a lot of people like to use in zero DT options. So it's a version of the butterfly. So I'll pull up another butterfly on the call side. And then from here, to make it a broken wing butterfly, what you'll do is you'll take the long leg that's the furthest out of the money, and then you can click and drag this out. And then what typically we see from customers that like to trade broken wing butterflies is they'll want to drag it far enough out to where they can collect a full credit. It looks like we're still not seeing a credit greater than the width of the spread because we're seeing like still red on this side. It looks like it's flickering around that. Let's just make it a little bit closer to the money. And then you can use this strikes button here as well, just to move the entire trade. That's something super handy on the order ticket as well is the strikes buttons. It's very similar to the quantity buttons, but you can use this to move it further in or further out of the money, depending on where you want to place your trade without having to click and drag each of the legs. And so we can move this sort of to right at the money. And then this could be our trade here. You'll typically get, I mean, it's the end of the day, so we're not receiving a very large credit of that. But here we could place it for, a 10, 15 cent credit, see if that gets us filled. And then from here, we can also look at the profit and loss graph of this as well. I think this is super interesting. So here, just to go over the analysis tab a little bit, we'll want to deselect here. Let me draw a box around where I'm looking. We'll want to, under this view analysis, we'll want to deselect all of the contracts, and then we can choose what we're looking to analyze from here. And so we just want the call side. And then so we can click on all of these. And then this will show us our profit and loss graph. So right here, just like the other butterfly, we have the profit and loss tent under there. And then on the left-hand side, we've got no risk to the downside because we're receiving a full credit. But then to the upside, we have a larger max loss because the width of that spread is a lot wider. And so let me just draw like some boxes around these zones here. So to the downside, we have no risk here because we're collecting a credit greater than the width of this spread. So the width of this spread is only 5 points, as we can see from the bottom. And so down here, we see the width of this first spread here is only 5 points. And if we're collecting a total credit from this long spread, or excuse me, from this short spread that we have, that's greater than what we're paying for the long spread, then there will be no risk to the downside. But because of that, because we're paying a debit for that long spread initially at the beginning of the trade, that's going to give us a lot larger of a risk that we would see rather than if we just place that short call spread, because we also have to take some of that credit and buy the long spread for it. So that's some of the risk reward for a broken wing butterfly. There's no risk to the downside if it goes down because you're collecting an overall credit. But if it does go up beyond your long strike, then there could be a lot greater max loss than you would see if you were just selling that spread. But if this is a trade that you want to do, it could potentially pin your short strike of 66.60, but you don't want any risk to the downside. This is definitely something that you could consider.
Exactly. It'd probably make you bearish if you're doing calls as well. You're because if it goes too high, right? This is a yeah, makes you a bit bearish on these. And so that's the beauty of the
Yeah.
broken wing butterfly is it's more flexible than the butterfly, but you don't necessarily have to take both sides like on a condor, or take really unidirection without much credit like you would on a spread or something else like that.
Yeah, and so this is a bit of a unique trade here because initially you want it to go down, but in actuality, in order for you to make full profit, you want it to slide up a little bit to the expected move here, just because that's where you'll see your max profit of 515. Whereas if it just goes below that last long leg of the debit spread, you'll still receive the full credit that you have, but it will only be 15 cents, 1.5 compared to your overall max profit that you could get by landing within that profit 10 of 515. And then from here, another strategy that I like to mention as well when trading zero DT options is the Condor. So not an iron condor, but a condor. And so that would be, we'll just go over this pretty quickly. If you think it's going to land between certain strikes, it would be to buy a debit spread and then sell a credit spread. And then from here, you want it to go just within the short legs. The only reason you would ever do a condor rather than an iron condor is to always trade the out of the money options. Typically, we always see customers trading the out of the money options because those are a lot more liquid than the in the money options, and it's still the same thing. One of the things we see a lot with traders is that if you're looking to, buy a really far in the money debit spread, this is a lot less liquid. I mean, for zero DT late in the day, it'll be trading for about the width of the spread. But typically, what you'll want to do is you can just click and drag and move these strikes to the other side. And then this would be to sell the credit spread rather than buy the debit spread, just because these options are more liquid. A lot more people are trading these options. You can also see from the open interest as well there will be a bit of a difference. So we'll see a lot higher numbers here than we would on the call side that's in the money, just because traders are typically trading out of the money options rather than the in the money options to hedge their positions, just because they're a lot less expensive. And to capitalize on that liquidity, if you want to buy an in the money debit spread, you can just sell an out of the money credit spread, and it's the same exact trade.
And again, it really comes down to with zero DTE, you're looking at the extrinsic value of the options. Once these are at expiration and they're fully intrinsically valued, they can be an absolute nightmare to get out of, because we know
Yes,
what's going
yeah.
to happen. We already know they're intrinsically valued, they're expiring today. It's pretty obvious what's going to happen. But when things are out of the money, you're still speculating on the probability that something could go in the money or something could move in your direction. And so you're really, with a lot of these zero DTE strategies, just keep in mind it's extrinsic value you want. You really want to scalp the extrinsic value off of the options market in the last day of expiration when things are sort of their craziest in a way. So yeah.
Yeah, and then where we can go from here, let's talk about some of the different products that you can trade zero DT options in as well. And so another product that we see that's super common, which also avoids the PDT rule as well, because it's a future, is trading the forward slash ES. And so you can trade the zero DTE options in this product as well. And so you can click on zero DTE, and then you could do, for example, just sell a put credit spread in this as well. But one thing that we really want to talk about when trading futures or anything besides SPX or XSP, which we'll go over in a second, but anytime you're trading something that isn't cash settled, there's possibility that there's exercise and assignment that goes to the outright future. So for example, if your position winds up right here, you could potentially be assigned one long contract for that 67.10 strike and then not be assigned or exercised into a short contract to offset that. So you could be long one forward slash ES contract overnight and that offers you a lot of exposure overnight that you may not be able to withstand in your account. So if you're ever trading these non-cash settled products, so anything like SPX is fine, NDX is also fine if you want to trade the NASDAQ, or XSP is also fine as well. That's sort of like SPY, it's the same size as SPY, but cash settled. Whereas if you're trading the futures, the exercise and assignment goes to the outright futures contract, and you do not want to be long or short a futures contract when you're not expecting it. That could result in massive profit and loss swings in your account that you were not expecting. And so, I mean, that's something that we see on the desk all the time, Luke. People getting assigned or exercised into a contract that they didn't mean to have. And then you see a lot of big profit and loss swings. So you always want to make sure to close it out before the close. Typically, we say anywhere like 30 minutes before the close is a good idea, just to make sure you have enough time to actually close out the position. And that's something we see all the time, right, Luke?
Oh, constantly, constantly. I mean, that's really, again, the biggest risk with zero DTE is the assignment and exercise. There's nothing like, waking up from the day before and, your buying power is negative, you have a margin call, and you're like, wow, I'm freaking out, and that's what we're here for. We'll always help you through those situations if that does happen. So, but again, these are self-directed accounts and you want to make sure you're understanding the risk here. Now, the beauty though of futures is that let's say 3 o'clock Central Time comes, which is typically when these ES contracts expire. The beautiful thing is if you are assigned or exercised, you can always go look at the capital requirements on the positions page, and you typically will see the futures contract already listed on the account. So if you want to show them where the cap rec is, yeah. So if you go to the cap rec, and then you open up, let's say you have an ES position, usually a few minutes after 3 p.m. Central Time, if you were assigned or exercised, you'll go ahead and see one -1 contract there.
Yeah, it will show
And
there.
it'll show there. You won't see it on your positions page though. So keep that in mind. You won't see it on the positions page, only the capital requirements. But if you do see it in the capital requirements, you can then buy or sell an ES contract to offset it so that you don't have to hold that contract through the overnight market and have that overnight risk with the futures. So this is one of the benefits of trading futures zero DTE versus equities. Equities take overnight for these settlements to occur, and you typically have to wait until the next morning to see what happened. With futures, we can typically let you know very shortly whether you're exercised or assigned.
Yeah. And then, so the reason we see a lot of people trade SPX is because there's no exercise or assignment risk because it all goes to cash. But if you want to avoid the PDT rule and you want to trade zero DT options and futures, you can do that as well. Mechanically, it's all the same on the platform when placing the trades. The products pretty much move one to one, the SPX and the ES. So you get the same type of moves, the same type of theta decay, and everything like that. But just keep in mind that when you're trading the ES, that there is that exercise or assignment risk. So please make sure to close out those positions before the end of the day, or you could see potentially a margin call, lots of profit and loss swings that you weren't expecting overnight. And so that's something to always keep in mind as well. And then something else we see people trade a lot for the zero DT options is SPY. And so when it comes to exercise and assignment here, it's a little bit different than the futures. The exercise and assignment will happen right away, and then you can see it in that capital requirement. But Luke, tell me about some of the after hours exercise and assignment risk that we see in SPY.
Yeah, so typically, let's say you have a zero DTE option, it's expiring and it's out of the money. Okay, let's say you're short, it's out of the money. Yay, I made my money, right? But then let's say, SPY moves 400 points or something ridiculous, which is doesn't happen that often. And let's say now you're short, which was out of the money at close, is now in the money. And so sometimes we get calls because people will get closed out by our risk team because they'll say, well, hey, my spread, my option was out of the money. Why'd you guys close me out? I thought, I'd won that trade. And so one of the issues is that in the after hours market, because equity options in particular don't technically expire until 11:59 p.m. of their expiration date, people can still put in exercise requests until about 4:30 Central Time, 5:30 Eastern Time on their options. So if there's a large aftermarket move in the SPY, you potentially can still be assigned. And so this is why if you don't have the ability to take assignment or exercise, even if your option's out of the money, unless it's very deeply out of the money by about 5% or has a zero bid or something else like that, where this option's clearly dead in the water, if you cannot take that exercise and assignment, it's typically good to go ahead and close it out and take just a little bit less profit so you don't put yourself at risk of that after hours assignment.
Yeah, I mean, typically like the zero bid thing is something that I really like to mention. So we see, I mean, how far out are we going? This is like, what are we at? This is like 20 points out here at 644, and this is the first strike that doesn't have a bid, as you can see here with zero bid, and we've only got an hour until the close. And so the market is telling us that some people are hedging their positions and thinking that it could go all the way to 645. Right at this very moment, as it gets closer to the close, it will be different, but we're seeing that, the market is telling us that people think it could go there. And so just to avoid that after hours exercise and assignment risk, we typically like customers to close out their positions before the end of the options trading session, just because you don't want to get pinned in between those short strikes. Let's say, you're selling this put spread, for example, or you sold it earlier in the day when it was actually worth something, and then it somehow goes in between 646 and 645. We would hate for you to get long 100 shares when you did not intend to. And so you always want to make sure to close out positions like that. And then just to talk about the time that SPY trades until, zero DT options on SPX and the ES, those trade until 3 o'clock Central, but SPY actually trades 3:15. So 15 minutes after the market close, they trade until 3:15 Central. And so you can actually close positions out right after 3 o'clock. So let's say it's like 3:02 or 3:03 Central, and you still have that position on and want to take that exercise and assignment risk off the table, you can just close that position 15 minutes after the market close. That's something that's super beneficial about SPY that you can take advantage of as well if you're not trading the cash settled indices. And so another product that you could trade as well for zero DTE, let's say you like the cash settled aspect, but you don't want the size of SPX, you can also trade XSP. So it's pretty much like the same value as SPY. You're just trading a smaller product, but it's cash settled. And so any exercise and assignment here is just like SPX, and it settles to cash. Something super beneficial if you just want a smaller size trade rather than trading SPX, which is, one of the biggest products out there.
Exactly. And most of those ETFs that track indexes will trade until 3:15. Anthony posted a list of them in our chat, so take a look. And yeah, that's there's a lot of things you can do besides futures, equities. Zero DTE is a pretty versatile strategy. Again, risky but versatile. And just to highlight with the futures products are not subject to pattern day trader rules. So if you have all your day trades and you still are feeling like you need to put something zero DTE, you can always hop on the futures.
Yes, yeah. That's something that's super nice about the futures as well, just because they're regulated differently. You can also trade those for zero DTE, and you're not subject to the pattern day trading rule for day trading futures a lot. So that's something super beneficial. But please keep in mind that expiration risk, just because if you let it go until the close, then you could get pinned right at, 3 o'clock Central, and then you could be long or short one futures contract when you didn't intend that. And then just before we go into Q&A here, there's a couple things I want to go over as well. Rolling zero DTE positions. So typically, if you have a credit spread that's about to expire in the money, then what can happen is you would be wanting to roll this position potentially. If you ever have a credit spread and you're trying to roll that to the next day, for example, or a further expiration, you're typically going to have to pay a debit just because the further dated option you're selling will not be as expensive as the 0 day one, just because it's already in the money and trading for the full width of the spread. So if you want to roll zero DT options and they're in the money and you sold a credit spread, they're going to have to be rolled for a debit rather than a credit. Nothing wrong with that, just something to keep in mind. And then also, in terms of a volatility metric, this is something I like a lot as well, that I like to have in a watch list. Do I have it on this one? If not, let's add it. Is the VIX 1 day. So VIX 1D. This will show the 1 day volatility in the VIX rather than, or just the 1 day volatility rather than VIX, which is the 30-day volatility. Because when you're trading 0 day options, the 30-day volatility doesn't really matter. And it's more the 1 day volatility that you care about when trading these options. And so if you want to look at this on a chart as well, obviously there's not going to be options available to trade this. But if you want to look at this on a chart, you can pull this up and then you can either have like the 15-minute candles or the daily candles. The daily candles look a little weird just because volatility always increases into the close, just because there's not much price for that to change. That's why the VIX 1 day always goes up into the close. But if you want to see how it's been trending, or if you want to look at it, how it's been trending throughout the day, you can pull up like the 15-minute candles, for example. And then this is something that you could look at on a charting basis to see how the volatility for the 1 day options are moving, just because that's the volatility that you care about rather than the volatility that's happening 30 days out. So it's just a little bit different.
Not
And
great. That's
then,
great.
all right, I think that wraps up everything I wanted to go over. Luke, you want to pick out some questions in the Q&A? I see we've got a lot of them, which is
Yeah, we
absolutely
have
great. I
so
love that. And so let's take a
yeah.
look at some of these questions. I see
I
some
saw one
questions about the
earlier for
analysis
theta
tab.
decay. I don't
Yeah,
know if we ever went over theta decay, did we? Um,
yeah, we can talk about some of the theta decay really quick. So when you're looking at the options. Let me pull up SPX. And so let's say you've got on like your Iron Condor. Let's ignore this position that we have on here. And so let's say you've got your Iron Condor. When it comes to the theta decay will not be linear throughout the day. You know, people will always ask a lot, right, Luke? Like, what's the best time to sell an Iron Condor in 0 DT options? And so the answer to that, you know, it just depends on the type of market that we're trading in. So if we're trading in a market where the theta decay is always happening in the morning, then it might be a good idea to sell it in the morning and then close it shortly after. Or if you're seeing that the theta and the options are staying bid all the way until the close, you can sell it towards the close. Or sometimes the theta decay is getting wiped out in the middle of the day. Depends on, like for example, when we had the Fed talk the other day, the theta is staying in those options the entire day right up until 2 o'clock. And so that's something that we see all the time on Fed days. And so it depends on the type of day we're having. And the theta decay can be dispersed throughout, the beginning of the day, the middle, towards the end. It really just depends on the type of market that we're in rather than, the like it's always like the theta decay will expire or really come out of the options in the morning rather than towards the end of the day. It always really just depends on the type of market that we're trading in.
no, exactly. And some of that is not just always theta either. Something to keep in mind is like really volatility, which is Vega, is also going to be huge, especially for those big days. Vega is always going to come through and kind of if there's a lot of news expecting a lot of earnings at the end of the day, you could see a lot of that extrinsic from Theta and Vega stick around until later in the day. But again, it's not something that there's no hard and fast rules with these sorts of things. You're not going to be able to predict what the Theta is going to do. You can get a rough idea with the macro events going on in the world, but it's just something you kind of have to keep an eye on generally.
Yeah, correct. Yeah. And then let's start taking some other Q&As that we see. And so I see a question about PDT rules. So in terms of like avoiding the pattern day trading rule, I see the question is, can you avoid the PDT rules by using a cash account rather than a margin account? The answer is yes, but when you're trading in a cash account, you don't have as many strategies. So you can't trade like option spreads in a cash account. You can only trade option spreads in a margin account just because of that exercise and assignment risk. And so we don't allow spread trading in a cash account. So yes, you can avoid PDT rules when using a cash account. But when using a cash account, you can't do all the strategies that you can in a margin account. If you just want to buy long options, that's completely fine to use a cash account and avoid the PDT rules. But if you do want to trade spreads, you'll have to have a margin account.
And also, cash accounts have cash account trading rules as well. So you can also get into a hot water on a cash account if you overtrade the cash account. So it's called a good faith violation. Not
Correct.
gonna.
Yeah.
So it's So really, these aren't our rules either. These are regulation rules. There's nothing we can really do about it. So just keep that in mind. If you open a cash account, no spreads and good faith violations can still happen to you.
Correct, yeah. And so I see a question here about like the theta decay in futures. So if you're trading the ES versus SPX, they pretty much move lockstep with one another. So if one's up 40 points, the other one will be up 40 points. And so today we're down 44 points in SPX. I mean, it'll pretty much be the same in the ES. There's a bit of a further dated contract. This expires in December, the Z5. And so that's why it's slightly, different by more than just 1 or 2 points is what we typically see. But in terms of the theta decay on the zero DTE options, I'll tell you this, if it's not the same, there's a high frequency firm that's looking to arb that out right away to make it the same. And so pretty much the theta decay, the Greeks will always be the same in the zero DTE options for the futures compared to the cash settled indice. And so if you're trading the ES, the theta decay will pretty much always be the same compared to SPX as well. Same thing with the deltas, the expected move, it'll pretty much always match the SPX. The ES will match the SPX just because they're pretty much the same products. And if they don't match, there will be a high frequency firm that is more than happy to arb that out super quickly. And so, yeah, typically the same if you're looking to trade one versus the other, you're pretty much trading the same thing, just except for that assignment risk.
Highly correlated. Not exact, but highly correlated.
Yeah, I mean, yeah, like pretty much the same product,
Yeah.
right? And then, oh, I see. This is something I want to touch on the analysis mode. And so, just to go over that again, we have YouTube videos that go over that, help center articles as well. But just to go over a quick overview on the web analysis, here, let me close the right side panel, open up the left. And then here, we'll want to click on activate analysis mode in the top right. So here's what we'll want to do. And this is on the web. It's a little bit different on the desktop, but also very similar. And so you'll want to click on activate analysis mode here. And then this will pull up the shaded areas of your profit and loss graph. And then from here, typically how I like to have it is zones at expiration for zero DTE options, just because you can't analyze anything theoretically within zero DTE. And so you'll always want to have at expiration clipped, and then make sure that you have all the legs that you want to analyze clicked here as well. And then this will show you the profit and loss graph for that given strategy. So here for our butterfly, let's just zoom in a little bit and then zoom in a little bit more. And then so here we go. Here's our profit and loss tent. Man, hey Scott, if you're watching this, we're doing a good job so far. You might want to keep us around. And so this is where you can view the profit and loss curve, and then this will show you just your P&L graph of the actual position that you have on. Super useful just to help with some of the comprehension and the understanding when it comes to the certain option strategies that you're using. Like, for me and Luke, like we just look at the option chain, and then personally, this is what I picture in my head when I'm looking at the option chain, right? I don't even like think about it into like this is just how my mind does it from using this platform for the better half of a decade now. And so this is what I always think about when I'm looking at the option chain. And so this is something that can help you get super familiar with all the different strategies and what their profit and loss graphs look like.
No, exactly. The analysis tool is so useful. It's going to keep you sharp with where the trades are going because we get these questions a lot. People will call in and ask us. They'll be like, "Hey, I put on a trade. What did I do?" And that's always an interesting question, right? So make sure you use your analysis tab so you know what's going on. And I think
Yeah. And then I
you
see
got any
another
other
question here
question?
about
Yeah.
like the alternative to SPY that has a lower price. That would be XSP. So this is like the SPX version, just the size of SPY. And so it trades pretty much at the same price as SPY. And then the XSP is also a cash settled index, just like SPX.